So next up, I've been informed, but I'm not fully aware, that there is a big announcement. It's going to be huge. It's going to be perhaps shocking to you. The next one is lightning strikes, the future of P2P credit.
Please welcome back to the stage Paolo Ardoino, CTO at Tether and Bitfinex and CSO at Holepunch, Mathias Buus, CEO at Holepunch, and welcome John Carvalho, CEO at Synonym.
Give them a warm welcome.
Okay, this one. Hello, everyone. So today we would like to talk to you about credit, actually peer-to-peer credit, right? We want to explain to you why credit is not a bad word. Credit is something that people need in their life. It's part of the human interactions since ages. But let's start a little bit with a brief history and also where we are today, right? So we have the global financial system. Right? The global financial system is banks, institutions, central banks, and so on. Before joining the Bitcoin industry, I worked for a while in the traditional financial industry as a developer, right? So I've been a developer all my life, and always excited to build, applications and networks, infrastructure that would resist to the wrath of God, right? But actually, one of the crazy things is that 80% of transactions, part of the traditional financial world, are relying on outdated technology. So on programming languages that have been invented in 1959. But also, they are one of the things that actually ties well with why Bitcoin exists, is that all this banking infrastructure, interbanking settlement systems have been so poorly designed and poorly maintained over years that this is one of the reasons why the cost of opening and maintaining a bank account is so high, right? So the cost of maintaining rubber bands for 30, 40 years on banking systems is going through the roof. So of course, the banks will not eat those costs. They will reflect those costs to the poor users, poor customers. So that's something that really is riddling all the banks, right? Anywhere. Sometimes I go to a few bank accounts and the bank interfaces, and they look like something from the 2000s, right? So no one knows why, but the banks have always the worst interfaces, right? So we live in 2022, and yet they cannot cope with the growth of the technology. So what's the solution that has been brought to us today, right? Global shared state networks. Blockchains are an example of global shared state networks. Right? Bitcoin is an example. But we will explain a little bit later why Bitcoin sets aside everything else. Right? But the global shared state networks are something that we are seeing growing in the recent years. All kind of networks, all kind of promises have been made on how these blockchains and shared state networks will solve all the illnesses of our world when it comes to, of course, value transfer, but also data storage, all the possible applications. So at some point, it felt like they could cure all the illnesses all over the world, really. So, why global shared state networks are actually a thing, right? So because you can milk users with that, right? So we are in Switzerland, so we picked this emotional gift for you. But the actual value created is not always clear, right? So you get blockchains that don't deliver anything better than others existing, or they don't solve actual problems. But the only result is that some VCs that bought in early are getting richer. So that's the thing that we don't like, right? Because that will create confusion in people's minds, right? Will create skepticism in people's mind. So what is basically the trade-off of blockchains, right? So we hear every single year there is always a blockchain that promises to deliver higher throughputs than the previous blockchain. So as you might know, Bitcoin has a block time that is around 10 minutes, right? In 10 minutes, there is a new block containing a certain number of transactions. That's it. So of course, would be it's easier to think, why don't bring down the block time from 10 minutes to maybe 10 seconds, and then 1 second, and then 400 milliseconds, right? Of course, this has been tested and attempted many times. So why do you think that Bitcoin chose such a long time to settle transactions and create blocks, right? There is a good reason, is that the world is different, right? So it takes time for information to reach all the different places of the world. So everyone, even with the worst network, even if he has to download the new block and its information from a satellite, will be able to get that, to receive that information. So it's about inclusion everywhere in the world. Then you have the other side of the barrier, where you have blockchains that have 400 milliseconds time. So it means that there is one simple concept is called speed of light. So one and the other that is fighting with it is the global consensus, so global shared state issue. So if you want to have a global consensus, so for example, Matthias buys a cup of coffee and John sees that transaction, because think about it, that's what it means global shared state, right? So why Matthias buying a cup of coffee should impact how much amount of data John should store on his computer running a node, right? But that is anyway the global shared state, and it's great for Bitcoin because with Bitcoin you need to, it's so decentralized, it's so strong that actually you need to validate everything. But Bitcoin is made just for one simple use case, that is preserving wealth and value transfer with certain limitations that are then improved by things like Lightning Network, right? But these guys, the other guys, thought, okay, let's make it so they are dumb, right? Bitcoin guys are dumb. Let's make things much faster. And so what happens is that when I talk about the speed of light, is that if you have a consensus that has to propagate all the smallest transactions that everyone is generating in its day-to-day life, it means that all these transactions have to reach out all the different parts of the world, as remote as they are. And so, of course, the fastest thing to deliver data is the speed of light, right? So, for example, optic fiber and so on. So that is the fastest you can get. And yet, if you, for example, send a message from Lugano to Tokyo, it might take 150 milliseconds, 200 milliseconds to deliver that message. So if you have a global consensus, it means that a message is a transaction, is value transfer in these blockchains, right? So imagine all these messages that have to reach out all the places in the world within 400 milliseconds, when the speed of light to send a message and the latency to send a message from Lugano to Tokyo is 150 milliseconds. And it's not just one message, it's thousands of messages that have to be replicated all across the world. So it means that when there is the tiniest issue in connectivity across the globe, everything falls down, right? So we are seeing blockchains losing or stopping for days. That's simple, because they decided that the trade-off was centralization versus decentralization. Because, of course, in order to solve this problem, the more you put nearby the servers that are validating all these transactions, the more reliable it gets, the more dispersed are the servers, the more terrible the user experience it is. Yet, global share state don't scale enough. Mathias, you want to talk about it?
Yeah, so basically, I don't know if you were here for me in Paolo's previous talk, but, we talked a lot about peer-to-peer networks, and it's just like Paolo was saying, it's we're fighting physics. There's no way you can get these global networks to scale enough, because there's basically, it makes no sense to centralize all. We should instead have many more networks. So, it's just an impossible problem, and it's also not the right problem to be looking at.
So yeah, you've heard Paolo describe some of what's happened in the past with blockchains and trying to use them for things they really shouldn't be used for. But in the end, like it says in the slide, everything but Bitcoin is centralized. So if you are if you take Bitcoin as the ultimate form of decentralization, you can say Bitcoin is really the only money now. As far as it's a market money, you have no more need for government-issued fiat. But there's still this concept of needing credit, right? And that's why we're here doing this presentation. So you could say, Bitcoin is money and everything else is credit. So that means Bitcoin is for when you don't want to use trust, and credit is for when you do want to leverage trust. So the question becomes what is the best format for leveraging, trust without having to make all the compromises of a blockchain? I think next slide, please. So yeah, we've used credit for forever. And I think that even post-hyper-Bitcoinization, we're going to continue to use credit. I've done a lot of thinking about, trying to model what it would actually be like if Bitcoin, took down big banks, took down big tech, took down big government, and now we were actually doing everything ourselves. I think that in the end, you still are going to have an advantage by trusting people from, against people who are just operating alone. So the question is, how do we position and leverage trust in a post-hyper-Bitcoinized situation? I think the answer is still turning credit into some sort of bearer instrument or an IOU of some sort, but it's not through using a global shared state, basically not through a blockchain. I think that blockchains just are designed in a way that does not actually scale. And so if you try to have these millions of different unique things in them and very tiny, inconsequential, ephemeral transactions, you're eventually going to bloat that thing to be very expensive, unusable, and just having tokens, having credit, in the abstract represented this way, it just doesn't scale, and it eventually becomes obsoleted the more people use it. So, as Paolo mentioned earlier, if Mathias is doing a coffee transaction that has nothing to do with me, I'm not the one selling him the coffee, why should I have to hold his data? And now if we want to use credit and we want to digitize things like, say, Amazon gift cards, Starbucks coffees, credit, airline miles, you could do monthly Netflix subscriptions, etc. If we're going to do these things and have these trusted issuances, why would we use a blockchain for that? When we already know we have to trust the issuer. So the question becomes, how do we design technology in a way where I get only the qualities I need out of credit? And I think you can distill these down to, you need some way to represent a digital bearer instrument, an IOU that's digital, where the only person you actually have to trust is the issuer. And if you can figure out a way to do this without having to use a blockchain, and also without just totally having to ask permission from the issuer to do every transaction in the database they own, if you can figure out some kind of in-between method between blockchain and between just a centralized database, then I think you would have the ideal and the only other format that you'd actually need to express credit in the world where Bitcoin is the main store of value.
So, like we talked about before, we've been talking about these problems for many months, and it's something very close to our heart. And I can't help thinking peer-to-peer technology all the time. It's it's my mantra. It's what I think about when I go to sleep. So obviously, we can all agree here, I think, that the solution is not global shared networks. It's also not like having 2 networks. It's also not having 5 networks. It's having endless networks. So what does this mean? So think about it in terms of connectivity, in terms of peer-to-peer, right? So there should be no limit on networks, and networks should not cost anything. You should be able to spin up as many networks as you need to create the networks that you actually, just the amount of networks that you need. So concretely, that could mean like if you're doing, a credit transaction, if I'm doing one with Paolo, me and Paolo should just have a network. That's one network. We don't have to include anybody else. We can if we want to. If I go down to a local store and I buy something there, maybe I want to have a credit network with them. As long as I stay in that store, like John was saying, if it's like a token that allows me to buy like extra coffee or stuff like that. That's just a network between me and the store, and maybe between other customers in the store. But there's like the added benefit of putting that network on a global state is basically zero, because at the end of the day, it's just between me and the coffee vendor. And the coffee vendor is also the only person that can give me the coffee back, right? So like the global state doesn't really help us, because if he doesn't want to give me the coffee, even though I technically paid, I'm like, I'm out of luck anyway. So basically, what we're trying to say here is like we need a system where everybody gets a network, and we can have tons of networks, but like still networks where the protocols running are interoperable. We're speaking the same things, so we can do interop, like where you don't have to invent anything. Kind of like going back to the mantra that we talked about in our Holepunch talk, also saying like, we don't want you to like, be PhDs in credit. We just want you to use these simple tools to build exactly the networks you need and just have as many of them as you want. And obviously we want them to be, free to run. So like they run on your hardware, and they should be able to run on what I like to call potatoes. Like they should not require any basic resources, because then like, we're just gonna go back to centralization again. Like the whole premise of having to install serious hardware in a coffee vendor's place is like just not gonna fly. It has to be things that can run on their cell phones, maybe a Raspberry Pi, but like, basically as little as possible. So we need to really take advantage of technology. And we looked around, and we were like, so how are we, what's out there? What can we do to pull it off? And like, I worked a lot with Lightning. Paolo has worked a ton with Lightning. We're big fans, John also. And there's some very, very interesting concepts in Lightning, especially state channels. So that's at least my developer word I use for it. So when you open a channel in Lightning and you're talking with another peer, what's super interesting about these channels is that it's basically a way for you to completely trustlessly express state transfers between another peer in a way where you have to put zero trust in another peer, using these simple protocols where things are co-signed and things like that, so you both have to agree on updates. It's a really, really powerful system, and it's my favorite kind of powerful because it's also inherently really, really simple. And having worked in decentralization and peer-to-peer for like the last 5-10 years, I can tell you that anything good has to be simple, because if it's not simple, it's just not going to work. And these ideas are really, really simple. So what we wanted to do is like, can we take those state channels and just like apply them to everything? So instead of having them tied to things like Bitcoin and blockchain, which is obviously a cool idea, but like what if you could tie them to anything? What if you could tie them to Starbucks coin? What if you could tie them to whatever you wanted? Like I could just make a Plan B coin for booking time to talk to me, or you could do that. What if we like no limits, right? Because it's all about that. And again, like with these systems, this primitive, we can even build, even though credit is somewhat trusted, we can build very, very trustless transfers into it. So it's super, super exciting and like a very, very powerful thing. So
we want to introduce pair credit. So I think that after today you have figured our pattern, right? So using pairs for everything. But so pair credit is basically an open, transparent, peer-to-peer accounting system. So first of all, we are not here to sell you a token. There is nothing, right? So it's just peer-to-peer, right? It's just bringing back how people have been used to interact with each other for centuries, for thousands of years, right? So it's just one friend talking to another, lending money, or exchanging something, exchanging goods, right? So this is not trying to solve all the problems of the world. I think John said it really well, right? So we are all Bitcoiners, and we think that there is Bitcoin, and then everything else is aside, right? So one of the things that moved us when we wanted to create this technology was, okay, why, since everything else is basically credit, right? Why we are going through the complexity of creating, super complex blockchains that hence are extremely slow, as well as we discussed, while you are still trusting basically a centralized issuer. So you don't need that. If you are in the end, if you are trusting a centralized issuer, yes, you can use a decentralized transport layer, but then you don't need to use a blockchain because then it's inherently slow. So we wanted to talk a little bit about the tree of credit, right? So this is a simple diagram that shows how we thought about it. So since everything is, so all the credit is centralized, right? On the top, you have, the issuer. The issuer can be, Starbucks, can be McDonald's, right? Starbucks has, their points. Every 10 points, you get a free coffee. McDonald's, something similar. And, of course, this chart looks quite big if you have a big corporation, but, it can be, the issuer can be even the single barber shop in a small town that wants to give, a free haircut after, 10 paid haircuts, right? So it can be anyone. So, and the second layer that you see in this chart is, nodes, that are, nodes that can, sublend credit, or that can interact and just like spread the load and avoid that the issuer, so the main node, has to deal with every single one of the peers that are interacting with the network. It's like a way to distribute the load, a way to distribute also the responsibilities in a certain way, and so on. And then you see the little peers that are basically the end users, right? So all them are interacting with each other through the Lightning style channels that Mathias has described, right? So the beauty of it, if you think about it, is that there is a recursion mechanism. So you have the top issuer, and then it could be multiple nodes, multiple layers or nodes, and peers attached to this node, and so on. And everyone settles through these, Lightning-style channels. And again, the beauty of it is that, is extremely fast and use well-proven technology, the same technology that we are using in Kit, right? That is sustaining ton of data transactions already. So, Mathias, you want to elaborate on?
Yeah. So I think the main takeaway from these things, in addition to what Paolo is saying, is also think of these things as basically free to run because they're running on your own hardware, right? So ledgers, peers, it's all just these Merkleized logs, which just means that everything here is basically a verifiable but somewhat trusted system of credit. So that means that for every transaction that's being done in the system, there's always going to be a proof back to the issuers. So you can always have a train of trust back, which is really, really powerful, and obviously what we expect. It's also built on the same kind of exactly the primitives we're building on, like Paolo was saying in Kit for Holepunch. So you get things like end-to-end encryption, fully authenticated transactions, and with the Lightning style channels, I think a very, very important thing is that it allows us to do these hubs that we're trying to illustrate here now in early drawing. So imagine that the main issuer is the barbershop, right? And this barbershop is just a normal barbershop. Maybe they're only open on Mondays, right? Using these channels, you don't have to always go back to the issuer. You can do these inter-ledger settlements where sub-ledgers can just settle between each other without talking to the main issuer. Obviously, it's a system of credit, right? So if you want to use that credit, you want to get a haircut, you got to go physically back to the store, and then you do that on Mondays. But you can transfer these credits yourself. So it's super, super powerful, and it's actually very, very close to how the world works originally, how financial sectors work. But we can use these simple things to just give a very, very, very strong amount of security and auditability to every kind of credit style transfers, while ensuring that it's like really lightweight and can run everywhere, which is very, very important to us.
Yeah, I think that the transparency of this layer being like a Merkle log that everyone can subscribe to and verify is extremely important.
It's like crucial, obviously.
Yeah, exactly.
So to kind of summarize the design, there are a lot of hardcore Bitcoiners that say like everything that's not Bitcoin is a shitcoin. And now we're trying to just basically establish that trusted credit is still useful. And when you try to propose different token layers and blockchains and things like this to these hardcore Bitcoiners, they'll say just use a database. And it's like, okay, but the problem with a database compared to using a token on a blockchain is that on a blockchain, I get to hold that right, that IOU, and I can transfer it peer-to-peer without asking for permission from the issuer, right? So how can I keep that quality but not have to always have all of my data in a centralized database? And so that's what this design is basically trying to accomplish, and I think succeeds in accomplishing, where the issuer can now use this append log, the same technology that Holepunch is using, and say, this is where we're going to issue our token, and anybody at the top level that basically has an account with us and owns rights to tokens directly with the original issuer, you can use your balance to create a new database, a new public ledger. And anybody involved with transacting with any of these ledgers can now transact with each other both up and down the tree and across different leaves of the tree. And so you can basically use this lightning style channels to have these off-state transactions to bridge across anywhere down the tree, across any ledger, and eventually across any asset. And so you can basically say, okay, you start here and you have this recursive design, and you say, how can I not have to be involved with the original issuer? Well, I take my balance, I make a new ledger, and I transact with people here. And if you can keep pushing further and further down and have this chain of trust. And if anything ever goes wrong, in one of your channels, unlike Lightning where you have like a punishment transaction where the blockchain settles it, you'll have automatic capability to basically show a proof to the issuer of your ledger and claim that person's balance. And so it's having the same assurances as Lightning Network for Bitcoin, but it's removing the requirements for liquidity channels and for routing.
And one thing I think is also just, super close to my heart is like, it really reflects how I use credit in the real world. So when I go on travels and with friends and family, we tend to use these tracking apps for spending, like to figure out who spent what, which is basically just a ledger in the system, right? And the trust there comes from, we know each other. So when we settle at the end of the day, when we're done with our travels, we add all our transactions together, we settle it. That can all be expressed as pair credit, which is super, super exciting because that's very close to my heart as a peer-to-peer enthusiast, because that means I can apply the same principle when I travel as you can with basically running a bank. Because it's the same protocols, it's all interoperable, right? So there's no reason why you need to have all these segregated versions of the same idea, because at the end of the day, it's all just credit. What we're just saying is like, let's standardize the protocols for this, make them peer-to-peer, make it all auditable, private, encrypted, all the good stuff, and just like apply it to tons of use cases. And you can basically run them as small as you want with exactly the amount of trust as you want. So that's super, super exciting.
So I would say that from a technical point of view, we can call it a Lightning-enabled distributed database, right? So it's basically a distributed database, right? So yes, as Bitcoiners would say, well, use a database. It is a database, right? It just use Lightning-style channels to make transfer data across peers much faster, so that you don't have the problem of a global shared state back yet again.
And auditable. And auditable, basically.
Yeah, exactly.
Super important.
So let's talk a little bit about the features that pair credit has. Of course, instant settlements, right? We talk about Lightning-style channels. That comes with instant settlements. No fees ever. So to clarify, again, I told you we are not here to sell you anything. It doesn't cost anything. And again, this is basically going back to what we said about Holepunch, right? So there is no control, right? This is open source software, and there is no DAO, there is nothing. It's just, everyone can create their own tree, as you have seen. If you are a small issuer, if you are like a massive corporation, it's still free for you, then as an issuer, whatever you is free to transfer data through the protocol. So just to be clear, the protocol is fully free. So no cost, no control, nothing. Then, of course, the issuers can apply their business logics. That's out of the scope of what we are doing. So, but they are not enforced. There is no way to enforce them, at least by the developers of the protocol.
And like, at Holepunch, like we talked about in the last talk, if you're around, we tag everything with this like really fundamental idea of modularity. Because at the end of the day, we just build tools that allow other people to build better tools. So when we were designing this, and we're still building it, then our main thought was like, how can we build this in a way where it does exactly what it needs to do? And that's like basically what we set out to do. So that means that pair credit is just about credit. It's about having a very small interface to just allow you to do credit. Like Paolo was saying, like there's many ways you can apply credit and apply the rules around it. That's not our concern, that's your concern, that's the business concern. And we just want to make it very, very easy for you to do any kind of application that you will want. So pair credit for me is like, it's not something you build on top, it's something you build next to, right? It's something that just helps your application achieve what you want. And there's tons of really, really interesting use cases around modularity. So obviously, that's why we're also super excited to bring it to Holepunch and Keat. So, we have these capabilities in the platform that allows for instant transactions and settlements and just all kinds of credit that you can possibly imagine.
Yeah, and I like also, there is the technological flexibility and modularity, and there is also the financial one, right? So if you are running, any commerce, if you are running like any platform, you don't want to spend years in trying to integrate in something. So again, these primitives on top of which pair credit is built on are extremely simple, so anyone with a little knowledge possible can integrate with them. So we want to talk a little bit about the possible use cases.
Yeah, so like it's first of all, like there's this use case explosion because we're also attacking this with this kind of mantra where it should be as easy to build on pair credit as it is to build on a Holepunch, basically. Like, we don't want you to be, again, a PhD in financial system. We just want you to be able to use web tech and have it to be that simple. And that's like the mantra we're going in attacking this with. And what's super interesting about that is like it allows for this crazy explosion of use cases, which is not even necessarily financial, but like you can think about where there's credit in everything when it comes down to it. Like when I was in college, we played a lot of World of Warcraft. I'm sure you played a lot of World of Warcraft also. And, in all these kind of games, there's all these in-game financial systems, right? And at the end of the day, they're credit. There's like a central issuer that's managing, in World of Warcraft, it's gold. And you can buy things with it, and you can transfer with it. And that just happens to interact through their systems, which is basically centralized and non-transparent. But that's just credit, So imagine peer-to-peer apps, just games using these kind of systems to transfer resources between each other. Again, all verifiable with protocols that are basically the same protocols that you can use to do financial systems, right? So you can, I like to think about it like when we bring it into Holepunch and into Keat, that I could actually bring in my World of Warcraft goal if that was running on pair credit and use that to buy things in Keat, which is like really mind-blowing. So it creates these very, very simple, powerful use cases, and you basically start to think like credit is everywhere. So it's super exciting.
Yeah, I definitely remember playing online massive games, right? And you had tons of items, right? Everything was an item. You had swords, you have iron, you have copper, and you have wood. You would use all that to build houses and do all the interactions. There was really a massive economy in these games, right? So, but imagine how much infrastructure these games would need, right? So they need tons of servers to run that type of infrastructure, to do all the accounting, right? And one thing is that these the things that you buy in World of Warcraft would need not portable anywhere else. So imagine instead if all this information would be actually spread peer-to-peer. So actually you can have like the gold that you accrued in World of Warcraft, you could use in another game and so on. But even more so, think about the scalability, right? So how we described Holepunch. So since it's the same technology, you can actually reduce the cost of infrastructure of building massive games and extremely popular games by basically bringing back basically to zero. So if you think about it, you can, since the Kit chat will be open source, then you can put a chat in your game with basically zero infrastructure. Then credit system, IOU system that well represents game, you take it and you can integrate it in your game, and yet the cost of infrastructure is still zero. So that, in the end, basically the users of your game are creating your own infrastructure, and I think is one of the most beautiful designs you can think about. And also one of the other use cases that, going back to the initial part of the presentation, I ranted a little bit about the current banking system, right? So imagine if actually banks could do a fast forwarding technology that they use, right? So in the end, all the money is already digital, right? So money is digital since decades, but is on centralized databases. And what if instead we could at least help the central banks and the interbank settlements systems to modernize a little bit so that the cost of the usage of this banking system will go down and will help people that cannot afford in regions of the world to have a bank account. Think about there are 2 billion people that are unbanked. Bitcoin is a great solution, but the truth is that many want still the dollar. So what you need to bring to them is a version of the dollar that they can actually use. So, and also on a layer that is good enough, is fast enough to have them interacting with others at a high pace with low transaction fees. In the case of if all the banks in the world would use a system like this, basically the banks almost basically trust each other, right? So imagine how the cost of banking infrastructure will go down massively, almost to zero, if they will all use these type of technologies.
And also one thing I just want to add there is like, I think it's super important just to remember to think about this as like it's not one big network. It's tons of networks, right? So I live in Copenhagen. I remember I went to a 7-Eleven recently, and all the 7-Elevens were unable to take my credit card because the system was down, right? All of them in the entire country, because they didn't have a way to kind of like segregate their risk and segregate their credit networks. And with systems like this, where it's just it's built into the protocol to be very resilient this way, you could have each city or even each store operate on their own credit networks, and then once they figure out the issue, they can just settle later, because at the end of the day, they probably trust their own credit things. So I think it's just super, super important to remember that, to be, these, like, the world really just needs millions, if not billions, if not trillions of credit networks. Also remember to think, we talked a little bit about it in the previous talk, but like, remember this explosion of connectivity and devices we have, like, self-driving cars, robots, all this stuff, right? It's going to be many ways of us to interact with credit in the future. And with all these different networks, when we can segregate it more and make it much more modular, that's going to be way, way better for privacy, and also way better just to actually scale it, because there's basically no way it's going to be pulled off afterwards. Otherwise, I think.
Yeah, obviously, like the system is basically achieving the scalability we're talking about by being localized, and so having only the people involved that care about the transactions means that you have this kind of mutual relative situation. So you only have to scale enough to be localized, which lets you avoid problems like if some larger network goes down, you could still transact within a smaller network. Paolo mentioned, how we could potentially modernize, banking and how credit works today using a system like this. Mathias mentioned how, we could integrate game systems, or any type of abstraction of credit that you could think of could be put into this protocol as well. And my personal, pet interest in all of this for a long time has been this concept of things like gift tokens. Like, how can you upgrade the user experience of gift cards, which today is like, I think approaching $1 trillion market. Last I saw, there's some projection within 5 years or so, they project that gift cards are going to grow to that size. That market is growing because people are using gift cards as money. And that means that when I try to pay you in a gift card, either as an employee or just, I don't want the gift card I have anymore, you have to trust that I won't sell that gift card before you redeem it, or that I won't redeem it. So we could literally upgrade the user experience and the utility of gift cards just by turning them into bearer instruments. And now that you have control and practicality to the system, they don't have to be denominated in $50 or $100. They don't have to be denominated in fiat. They could be denominated in products and services. So like I mentioned earlier, you can actually have a token that represents like a Starbucks large coffee or a hamburger, a Big Mac. You could have a token that represents a month of Netflix subscription or such. And now if you take what Paolo said with modern banking, good old fiat, bad old fiat, gaming tokens, gift tokens, and now you imagine they're all using the same protocol. Now you can start thinking of the next stage where you have interoperability across these systems. Because they're bearer instruments, that means they can have order books, they can have like true aftermarkets. And so you can imagine now no matter which type of credit you have, or Bitcoin, you can go to a merchant that's plugged into this network and pay them in anything, and they won't care what you pay them in because they'll just sell it at market rate because they can automate with some sort of exchange or payment processor and be able to say, do something like Dunkin' Donuts can take Starbucks gift tokens for large coffees at some sort of exchange rate, and you can just use them anywhere. And they don't have to worry about what they're being paid in because there will be an aftermarket that is reliable with actual order books and exchange capabilities.
And of course, many use cases that we cannot even imagine yet. So another important news is that, of course, this is an open system. There is, again, nothing to sell. And it's already in well progress, right? So we have all the primitives through Holepunch and /tags, right? So the progress on this technology is well ahead. And so we plan to have the finalization of the technology by Q1 2023. Early 2023 anyway. And also we believe that it is important to open this initiative to everyone, right? So again, there is no doubt, there is nothing. So we want to invite companies to join us in Tether, Holepunch, Synonym, that are the core founding members of Pair Credit, but we believe that others can also play an important role in expanding this idea, this technology that can bring basically no-cost transactions, infinite credit networks to everyone. One more thing. One more thing. So I guess you could figure it out, but of course, Tether is thinking to launch some of its products on Pair Credit. Thank you very much.